Morning, everybody. Hopefully, y'all are having a great Thursday. Looks like none of my... Oh, there we go. Now popping up. Looks like my audio is working. So yesterday, had a really good day. Made a... Sorry, I'm getting an echo. There we go. That's better. Okay, so yesterday I made $766, which is my biggest positive day so far for January. Biggest loss day was $583, so we're making back the money that we lost last week. Biggest trade that I took profits on was a put debit spread that I had opened yesterday, and if I had held it today, I probably would have been at max profit, which, you know, definitely left some on the table there, but I still made $390 of profit, so still pretty happy with it. It was on par with my other biggest trade for the month. I still do have the Netflix call debit spread open, assuming over 332.50 tomorrow is the expiration date. I should have set the expiration date for a week out. That's usually what I do if we have a Thursday earnings, but I didn't really think that one through too much. So I do think that is a possibility that could be the saving grace for the market if we do get a good Netflix earnings, a good kickoff, I guess, to the tech earnings that are coming up over the next couple of weeks. So that would definitely be a pivot in the market. I would say it's going to be pretty hard to get back to where we were, though, right? We were all the way up at $3.99 yesterday morning, and now we're at $3.89. So we're down a good, that's only saying 0.5%, but $10 off of 400, it's like 2.5% over the last 24 hours, basically. So very rough start to the market. We're actually rallying a bit, and I do think that it could be possibly overdone. So in my morning analysis, I talked about the economic events or the economic data that just dropped. So we got the Philly Fed Manufacturing Index, which came in slightly better than expected, but it was still negative. And that means that, at least for the city of Philadelphia, they're not producing as much. So whenever there's less that's being produced, you have a lower amount of supply, and we still have an ample amount of demand, and prices are based on supply and demand. So once supply starts to fall, the prices are going to rise unless the demand is crushed at the same pace that the supply is deteriorating, or if it's going down faster. If somehow, you know, demand is really getting punched in the face, then prices would start to come down, actually. But I don't see that really being the case, at least for like everyday goods. Maybe for high-end goods like vehicles especially, we are starting to see deflation in very high-end goods like vehicles, houses, and things that people just generally can't afford right now, because, you know, if you buy a vehicle, it's going to cost you like $1,000 a month for your monthly payment. Or if you buy a house, you're paying like 50% more than you did if you purchased it whenever interest rates were lower at 3%, and now the mortgage rates are like 7%. So people have a lot less buying power for those higher end goods, but still plenty of buying power for everyday items, services. We're still seeing inflation in services. That I think will prove to be pretty sticky. And then everyday goods, eggs has been all the hype recently. But yeah, still seeing inflation in those areas, but for high-end items, we are starting to see deflation. And I think, actually, this is purely speculative, as with any trade that I make, so don't take my word as gospel, but I do think that we go back up to 392 above the lower end of the risk range that was set for this week. Unless Netflix just has a horrible earnings report. But considering that we're still seeing sticky inflation for services, and Netflix is a service, I don't think that people are just going to cancel their Netflix subscriptions. So I think that they're going to have an okay earnings report. And Wall Street expects like the absolute worst for Netflix earnings today after hours. So I think that, like I said in the beginning, that Netflix could be the saving grace for the market this week. We could do an SPY, call debit spread, or we could also do QQQ. So QQQ is going to react better, or I guess more violently, one direction or the other. If it's a bad earnings report, then QQQ is going to fall more. But if it is a good earnings report for Netflix today after hours, then QQQ would rally more than SPY would, because QQQ is tech focused, and this is a big tech earnings. SPY is more broad. You have industrials, you have staples, and things of that nature. So it's not just tech, which is basically all the Qs is the top 100 tech names. So I'm actually going to do a QQQ call debit spread. I'm assuming that SPY is going to go up roughly 0.75%. So I would think that would mean about 1% for the Qs, which would probably put it, let's see, 277 times 1.01 would be 279. Conservatively, if you want to be a little bit more liberal, then you would go with 280. You get that for cheaper, obviously. I am making some money on something in my portfolio right now, but I'll have to revisit that later. So I'm looking at the QQQ trade, assuming that it's going to be over 280 tomorrow after, they just changed all of the interface on Robinhood on the mobile, which is very weird, but okay. Yeah, so I'm assuming that it's going to go over 279. That trade is currently 33 cents, which is, I think, a little bit expensive. And then the next trade up is only 22 cents. So I'd rather take on the smaller risk per trade than the 30 cents. So I'm paying 21 cents for this, 30 cents for the other one. So I'm going to go with the cheaper one. Again, there's going to be more volatility for QQQ than we'll experience for SPY. And for this trade, I would probably be willing to put down a good anywhere between 200 and 400 is what I've been putting down recently. So this one, I don't have as much confidence in because, I don't know how Netflix earnings is going to be, but considering how low Wall Street estimates are, I think it's going to be a decent beat. So I'm going to go halfway. I'm going to spend $300 on this trade. So I'm somewhat confident, not super confident. And right now these are going for 23. So it's a call debit spread, assuming that QQQ is going to go above $280. And that did not get filled at 23. God dang it. Come on, Robinhood. Oh, yeah, it did. Last minute fill, but fill nonetheless. So I opened that call debit spread for QQQ. I think that could be a really big trade if Netflix earnings goes well. And I would make money on both the call debit spread that I have for QQQ that I just opened and for the Netflix call debit spread. Just opened a new QQQ call debit spread. This one expires tomorrow. Hopefully I set it for tomorrow. Pretty sure. 120 at 23 each. And my strike prices. Again, I'm assuming it's going to be over 280. This is a call debit spread, and I spent around $300 for it. Actually, $350 for it, but that's okay. Netflix earnings today after hours. First big tech earnings might change sentiment for overall market. And then I have a deeper analysis in the weekly watch list. So I did the price analysis for it. I did the earnings analysis for it. Well, what the heck? There we go. So we'll see. My assumption is going to be a decent beat for Netflix. Why did Discover drop so much when they beat their earnings? I haven't checked into that one, but I will. BlackRock is falling. It looks like all the banks are actually coming down, which works well for me because all the puts that I have for banks. Looking at the macro watch list, IWM is down the most. Dow Jones is down slightly, negative 0.3. QQQ is actually performing the best today, interesting enough. The 10-year Treasury rate is up today. Reason for that is because the jobs report came in much better than expected. So that means that the Fed has more work to do to cool off the labor market, which was stated by Fed Collins, who said that, let's see, labor market needs to be in better balance. This is critical to achieving our inflation targets as labor costs still growing too rapidly, not consistent with their 2% goal. And then Collins said, seeing noticeably slower goods inflation, but services inflation, just like I'm talking about, remains persistently high, says would need to see moderation in shelter inflation in the spring of this year. And I actually do think that is going to be the case. I think that, people can't afford to pay $2,000 for rent anymore when their grocery bills have gone up a few $100s, right? I've actually started to see deflation in rent prices recently. I'm looking for a new place. And there's some decent places that probably would have cost like $2,000 if I was looking a few months ago, and now those are like $1,700. So we are starting to see deflation again in homes and rent and vehicles, high price items. It just needs to come down in order to fulfill, those vacancies. If a person can't rent out their home, then that means that they're paying on their mortgage, so they have to lower their prices. They're paying full price for their mortgage, when if they lower their prices by a few $100s, at least they're getting some money and not having to foot the whole bill for that rental property. So anyway, why did Discover drop? What is their ticker symbol? Is it just D? No. Discover. Screenshot of the QQQ. Shows expiration date today. Did it? I fucked up. Okay. That sucks. No wonder it was so cheap. That makes a lot more sense now. All right, so that means that we're going to have to get out of this trade pretty freaking quickly. Could just roll it if I want to. But let me see. Right now it's down 120. QQQ. All right, so Discover. Let me see. QQQ. Lost 20% since opening this. Go figure. Started to get a little bit of a rally this morning, but we're giving some of that back so far. But reaching 280 today by the end of the day would be a pretty tough feat. I think maybe we go to 278 if I had to guess, but right now with this pretty decent red candle, might be pretty hard to get back up there. So we're going to have to roll that one. I'm just going to open the new one and then focus on closing the old one later. So I'm buying the 279, selling the 280. It's going for the same price that I bought the other ones for. Funny enough, January 20th expiration date, 2, 3. And I think it just dropped to 22, but I'll take it. Thank you for the correction on that. All right, so let me post that new one. All right. New options, alerts, premium 101, freemium. Accidentally opened 119 expiration when meant to open 120. Got it for the same price at what? 345 over 15, 23 each. All right, and still 15 of them. But now we try to get out of the wrong position. It's down currently $200 of the $350 that I spent on it. I want to go to option strat, see how much it could be valued. If we go, I would say 277 to 278 would be likely sometime later today. Price action is definitely bearish with a RSI below 50, so that doesn't give me much confidence for this trade. And given all the economic data that came out today, I think it's just better to cut the L now than to keep on holding it. All right, they're going for 8 cents each. 9 cents at the bid. I'll try to get out at 10, but we'll see. So I have 15 of them that I opened for 23. So this will be 13 times 15. $195 loss for a stupid mistake of mine. But it does happen. All right. Limit order to close the old ones at 10. All right, limit order to close the wrong ones with 119 expiration date at 10 each. Premium 101. Oh, that blows. Roddick is just laughing his ass off. Is this funny to you? Losing $200, Roddick? Come on. And of course it doesn't fill because, you know, Robin Hood. Gotta love it. You gotta love it, man. All right. We're going below that 275.15 mark. I guess I should probably do a little bit more of a price analysis on this one, huh? We'll see if we bounce there or not. I'm not sure where that price level is coming from. Probably the daily chart if I had to guess. Yeah. Decent gap down this morning. 277 would be the mark to look for if we fill the gap by the end of the day. I don't see any positive spin for today, so I think probably going to keep on headed down or trading flat, if I had to guess. And the other call debit spreads that I opened are also down 20%. So, yay me. Been learning to trade with order flow. What's your take on order flow? I don't really follow order flow. Never been something that I've used personally. Some people find it useful, but I've just never incorporated it into my trading style. The main thing that I focus on is economic data and trading around events like earnings reports. That's just, everybody's going to have a different trading style, right? Some people might prefer to trade just solely based on technical analysis. Other people like order flow. It really just, it's about what best fits your style, basically. So you can try order flow. If it works for you, then great. I haven't found it very useful for myself, though. Good afternoon. Okay. Please fill my order, Robinhood. Watch it just rip up to 280 by the end of the day, though. Just to screw me over. Alright. I might have to drop the bid or my order to 9 and take the extra 15 loss. Oh, Jesus Christ. They're trading for 7 now. What the hell? Y'all are brutal. Alright. I'll place the order for 9. I'm not going to go to 8. That is a big red candle, though. Candle of significance. Right around 276.40 would be the new resistance level from that. Replaced limit order at 0.09 premium. Oh, for the love of God, please just let me exit this. Have mercy on me. Markets are like, oh, I see you made $400 or $700 yesterday. Huh. Let's take that right away from you. Am I also trading strategies with undefined risk or only spreads? Mostly spreads. Sometimes I will do calls or put options for earnings reports if the implied volatility suggests so. So the way that I trade around earnings reports is mostly spreads if implied volatility is high. But if implied volatility is low enough, then I will just buy a regular call or a regular put option, depending on, obviously, which direction I think the stock will go based on the earnings. So the way that I gauge whether I do a spread or whether I do a call or a put option is based on what's known as IV percentile, which is a nice little study. It is a custom study that you have to find on Google. I wish I could put it in the chat, but it's too long of a code to put here. But if we look at IVP for, say, Netflix or earnings is today after hours, and we go back to the 1-year chart, IVP is currently at 63. So that means about 37% of the time, implied volatility has been higher than it is ahead of this earnings report. Usually earnings reports are extremely volatile. So this would usually be in line with like 80 to 90 or even higher on the IV percentile. So if it's above, I would say 70 or 80, usually I'll do a spread option. That way I don't have to deal with as much IV crush. But if it's below 70, then I will just do a regular call and regular put, just because there's not as much volatility baked into the options, which is very interesting. I would have thought that there would be more IV percentile for this earnings season, but pretty much across the board from the stocks that I've traded, the first 3 stocks that I've traded for earnings, all of the IV percentiles have been dead low. Like this one, Netflix is 63. I actually bought the call option yesterday when it was at like 50 on the IV percentile. And then I also traded United Airlines, which was at like a 1. Oh, it finally executed that order to close the mistake call debit spreads that I opened for QQQ. But IV percentile ahead of UAL's earnings report was way the hell down here. But actual volatility was pretty insane. Like they gapped up overnight all the way up to 53.26. It went to a new yearly high, and then it fell all the way down to 48. So implied volatility was way underpriced. I also traded, what was it? Some bank, yeah, Charles Schwab, another one that had super low implied volatility heading into it, almost 1 on the implied volatility percentile. Meanwhile, look at Charles Schwab the last 2 days after the earnings report. This fell from trading at 83. The next day it opened at 81. I was able to like double my money on that. And then if I had held it to today, I would have made a little bit even more. But I took my profits and it's like $350, right? So if implied volatility percentile is extremely low, then it's time to go long and buy a call or buy a put, depending on which direction you think it's going to go. And then if implied volatility percentile is high, usually above like 60, 70, or 80, then you want to do spreads, and that'll mitigate your risk. New here, what platform am I looking at? This is Thinkorswim. Are you also trading strategies with? Yeah, we talked about that. Have I ever been assigned with any of my spreads? Yes. If you get assigned, you can just exercise the opposite option, the one that you bought, and that will balance out the assignment to where you'll buy the shares, sell the shares at whatever strike price you chose. And since you have a margin account, your broker is going to take care of it for you to where you don't need the 100 shares times the share price to front, right? Your broker takes care of it for you if you exercise the option that you bought. After, of course, the option you sold gets assigned to you. Every contract I try to close seems to be of non-value, iron condor, call debit spreads, etc. Yeah. Well, you have to be able to spot decent opportunities. Like even with spread options, you have to know if it's a good value trade or not. So the QQQ call debit spread that I was looking at this morning, the reason why I opened it is because right now SPY is trading below the bottom end of the risk range, or where it was expected to be by the end of the week. 2/3 of the time it's supposed to be within that range, and right now it's outside of that range. So odds are stacked in my favor of SPY going up. And my reasoning and analysis behind that is Netflix having a good earnings report tomorrow. And I was able to pick up those spreads at 23 cents for a $1 spread. So that means I have the potential to make up to 100 minus 23, $77 for every $23 that I spent. So, the likelihood of this trade working out just based on looking at delta values is pretty low. Like the delta on it is probably like 15 or 20, right? But based on my own analysis, I have a mental delta of probably like, I don't know, 40, 50. I would say there's about a 40 or 50% chance of the trade working out and the options becoming in the money, where the markets think that there's only a 15 to 20%. So you have to find that discrepancy. You have to have a mental delta. It's mental gymnastics and probably a bunch of bullshit, but this is what works for me. So, yeah, I trade using Robinhood, and the charts are looking at on Thinkorswim. I was up a decent amount this morning, up 320, but now giving all that back, which blows. But the call debit spreads are basically break even at this point, so not too worried about that. The BLK put debit spreads, they're getting close to being in the money. I chose a 730 strike price that I'm assuming BLK will be below by the end of the week. Let's see if there's any more bank earnings that are scheduled for today. And that'll be the decision on whether or not I close these. And that's new. I've never seen this before, but looking at the earnings schedule, we have Independent, that looks like a bank, but I'm not sure. We have Ally Bank, not really relevant. They don't have the same portfolio, I guess, as BlackRock, I think it was. Yeah, BLK. Yeah, I don't think there's any other earnings that could potentially shift BLK. So I think it's best that we just cut our L at this point for BLK. It's only going to be a $30 loss, which is better than taking the max loss, which I spent $160 for. Let me check the price. Currently at 738, I'm assuming under 730. I would think with Schwab falling as much as it has, BLK has a very similar portfolio. So it would follow suit with what Schwab is doing. But it hasn't fallen, the 5-6% that Schwab has. So it's possible that this trade could work out, but I would say improbable that the trade work out. So for me, I think it's time to cut the L. I'm going to have to go to, Trade Aries. This is a broker that I used to use but can't use anymore because I have a 90-day restriction from day trading. But let me link this. All right. So I usually just pull my quotes from here for spreads because they're going to give you a much better bid-ask spread than what you can get from Robinhood. Way better. So I chose a 732, 730 strike prices. And the bid ask that they're quoting me for is 170 and 190. So I could probably, actually, that doesn't seem, oh, I'm looking at calls. Whoopsies. Didn't switch it to puts. Yeah, it would have been better if I chose calls, but took the wrong side of that bet. Okay. What the heck? Cancel this order altogether, please. Options. Puts. 732. Yep, that one. Order. Why is it not getting rid of the calls? God dang it. Okay. Now it should work. So they're quoting me for 60 and 80. So Robinhood is quoting me for negative 20 and 160. So obviously Robinhood's not exactly right. But I'm gonna close these at 60 a pop. I originally paid 84 each, so decent $48 loss. And looks like, oh, they did fill me at 128 for the two of them, so 64 a piece that I was able to exit them at. Closing options alerts. Premium 101 premium. Just cut losses on the BLK 732, 730. Put debit spread. This one expires tomorrow, 120 at 64 each. 730, 732.5. Originally opened those at 84. Originally open 2 at 84. So for me, that was a $40 loss. Whoopsies. 40 loss. I have a question. How can I close a call credit spread if I made 100% and the bid ask are 1? You could just let the option expire. But if you really are set on closing it before the expiration date, you might have to close the spreads at like 2 cents each. You're saying the bid ask is 1, so you could just type in the closing order for 1 and you should get filled on it. If that doesn't work, go to 2, and if that doesn't work, then it should work. But if it doesn't, then just keep going up the ladder, like 3, 4, 5, if you're dead set on closing it. If you want to realize that extra, $2 of profit for each spread or whatever that you have, then just hold it into the expiration date if you're still confident in the trade working out for you. What's my thoughts for SPY today? My thoughts is bearish. So if we go to my spreadsheet, drive. Speaking of spreadsheets, this will be replaced very, very soon. I will show y'all what I am currently working on. It's going to be a beautiful app that's way better than this spreadsheet. But if we go to the calendar that I have, so I write down notes every single day of what I think the markets are going to do. So today, bearish. I would probably say maybe neutral, just given that we've fallen so much. But my reasoning, economic data came in very bad today. Jobless claims was much better than expected. So we're likely to see more increases in the interest rates, which we did see for the 10-year Treasury yield. Since the Fed has more work to do to cool off the labor market, which Fed Collins made a comment on, bringing the labor market to balance to curb inflation. Philly Fed Manufacturing Index also came in slightly better than expected, but it was still negative, and this is a proxy for the supply chain. So with the supply chain weakening, if our supply falls faster than our demand, then the prices for goods are going to go up. And then finally, this is going against the 25 basis point rate hike odds currently at 96 for February. If we go over to the FOMC countdown, this is currently estimating a 96% chance of a 25 basis point rate hike on February 1st. So the bond market is dead set on getting that 25 basis point rate hike at this point. And with this incoming data from the jobs and from the Philly Fed Manufacturing Index, with production lower and inflation possibly going higher, they could rug pull the market by going with the 50 basis point rate hike, but the odds of it are very low, only a 4% chance. So there is some chance, but it's very little. But yeah, overall, bearish, maybe neutral on SPY today. because of the economic data that came out. Neutral because we've already fallen like 2.5% since yesterday. So we've already realized a lot of the pain from these economic reports. QQQ is currently trading at 276. IWM looks like actually QQQ and IWM are performing the worst, and Dow Jones actually is slightly better. So industrials are doing okay, whereas tech and growth are taking the hit today, even with the 10-year treasury rate. Well, I guess the 10-year treasury rate went up today, so that does make sense that those two would come down. The dollar UUP is down 0.18, so another down day for the dollar. Seems like it's just continuing to get weaker and weaker, which usually happens during recessions, just because people are making less money. But let's see. Gold is what I want to look at. Gold is making a little bit of a rebound, back to 178 at the moment, almost 179. I do still have the gold leaps that's expiring in June. I still also have the call that I sold against it. That one I'm getting a little bit worried about, because even with the 10-year treasury rate going up today, the dollar is still headed straight down. So I'm kind of worried about getting a sign to have to get rid of my leaps option. I would still make like a $700 profit for it. If we head on over to Robinhood, I'll show that. Looks like we just went negative for the day. Netflix is dragging us down, and then the QQQ trade dragging us down. UVXY trade is basically max loss because UVXY is nowhere close to 750, even though it is going up today. Just chose the wrong date. If I had extended it maybe for a week, that could have been better, but Tesla is actually making its way back up. UVXY is up 3% today, 592. I still have my 500 shares. I could sell some cover calls on UVXY, collect some premium out of that. That might not be a bad idea. But the gold trade currently up 810. The cover call that I sold is currently losing me 75. So I bought the 150, sold the 181, so that's a $31 difference. So that means I make $3,100 of profit just from the difference between the strike prices, but I paid $2,400 basically, $23.75, and then I collected how much credit for the 181 call. I collected $93 credit, so I add that. So my total profit would be around $818. And if I closed it right now, I'd actually make less than that. So I think we hold it. If it gets assigned, it gets assigned. I think I'm just going to have to take on that risk. And this only has like 5 months till expiration anyway, so it's not really a leaps anymore. So I think I'm okay with that. All right. What else? The Bank of America 37 put, still not making us much. Still think that banks are going to have a rough time by the end of the year, just given, people not buying homes right now. I've been seeing a lot of homes getting listed in my area recently, like a lot more than usual, especially during the wintertime when nobody wants to move here in the Northeast. So it's very interesting that it's starting, I would say, to become a buyer's market. We're still not in that territory, I would say, but we're starting to work towards that after the, crazy seller's market that we had over the last, 3 years. So to the people who saved their cash during the last 3 years, they will get a much better price than the people that overpaid in 2020 and 2021. all the earnings stocks are down for today. Wells Fargo, BlackRock is down. Bank of America down. Netflix. Netflix is getting further and further away from that 332 strike price, which worries me a bit. Yeah, I would say housing prices are still way too fucking high. Unless you're okay with moving to a slightly worse neighborhood. I have seen some places going for like 200 for, 2-bedroom, 3-bedroom. It's usually like 1.5 baths here. For whatever reason, Pittsburgh just doesn't love bathrooms. You only get like 1 bathroom, even if you have like a 4-bedroom house. It's ridiculous. But in certain neighborhoods, prices are okay here, and the neighborhood specifically that I'm looking at, I think, is really starting to probably appreciate in value. From what I'm seeing, there's a lot more money that's going into that area. So it is kind of, enticing me. Haven't bit the bullet on it yet, but we'll see. I still want to see prices come down. Like that $200,000 home, I'd rather, purchase it at 170 if I can. And, in Pittsburgh in the Northeast, the best time to buy seasonally is usually in February and March when nobody else wants to move because demand is so low, right? Nobody wants to move when it's snowing like hell and there's ice all over the road. So I might be able to get a better price if I wait just a couple more months, especially if, the economy starts to really unwind. We're starting to see a lot of layoffs in big tech names. Like Microsoft just announced layoff of 10,000 people. Having 15 bathrooms in a house is such an American thing. Not in Pittsburgh, apparently. Spy puts are printing, yeah. It's down 0.7%, but it's kind of flat from the open. Not really moved much since the open. So I think the neutral trade is probably the best way to play it today. Maybe we do a put credit spread. I was bearish for today, but I think a lot of it's already been priced in. That's my best guess for today. I would say we're probably going to stay above 387 or 388. We'll see if we can get a decent credit out of that, but my guess is we've already overdone the sell-off, down 2.5% over the last 24 hours. So I'd rather take the opposite trade. Assume that we're going to be above 387 by the end of the day. It's only paying 13 cents credit, so that's not even worth it to me. If you go 388, you're taking on more risk. But that is paying 20 cents of credit instead of the 13 cents of credit you get for one strike price lower. I'd say we're neutral today, though. 392 and 387 would be my guess. So let's set up an iron condor, assuming over 387 and below 392. So we won't get back to the risk range today, but maybe tomorrow after Netflix earnings, after hours today. Right now, this is paying 30 cents in credit, which is okay. I'm more worried about the downside for this trade than I am for the upside, personally. And I would like to see more credit out of it, like 30 cents for that tight of a credit spread or that tight of an iron condor. I would want to get more out of it. So maybe instead we could do an iron butterfly that'll reduce the amount of risk that we need to put on. Now, let's try to determine a strike price that it could end the day at. I would say 391. There's an okay chance. I saw somebody set up a very interesting iron butterfly over on my premium Discord that I really want to revisit. I'll have to revisit that after because it's a very complicated strategy, but like there was a very small margin of error but a lot of profit that you got out of the trade. But yeah, I'm gonna do the iron butterfly assuming 391 by the end of the day. I'm not gonna take on too much risk for it, but I would say we're probably gonna be below 393 and probably above 387. So this is going to be a lopsided iron butterfly, which means that our collateral is going to go up. So I'm putting on $192 of risk to make 210. I'm hesitant on that. I'd rather put down like $150 of risk personally. So let me reduce the strike price width. So we're trading at 389 right now. I'm going to choose a 388 that we're going to be above, and then hold on, actually. So an iron butterfly, basically assuming that we're going to be at 391 today, so we're going to sell a call and a put with a 391 strike price. And then buy a call, I guess, 3 strike prices higher at 394. And then, whoops. And then buy a put with 3 strike prices below at 388. And that one we only risk 100 to make 200. So that one I'm A-okay with. The bid ask just keeps moving around too much, but we'll try it. All right, I got 198 for it. Iron butterfly, assuming we're going to be 391 by the end of the day. New options alert. P1F. Just opened a new SPY iron butterfly. This one expires today, 119. $1.9. God, I can't read. 8 each. And then I'll type in my strike prices. 388. All right, sweet. So that'll probably be the last trade for today. So let me type in all the trades that I made and closed. Well, that will be the end of today's live. Head on over to the drive. January log. Why don't I play SPX? It's liquid. Robinhood doesn't have SPX, and I don't have any money on any other broker. So that's why. I want to switch over to Aries, but currently have a 90-day restriction for it, so don't have that option at the moment. SPY, both. Iron butterfly. Whoops. This is a neutral strategy that expires today. Strike prices were, what was it, 394 for the call. Whoopsies. And for the put was 388. 388, not 338. That would be insane. But 391 was my short strike price. I got one of these, and I got paid 1.98 credit. And then I also opened the QQQ call debit spread, bullish strategy. I'll type in the one that I accidentally opened to. It was 279, 280 strike prices. I opened 15 at 23 each. I closed them for 8 each. So that one I took a $225 loss because of a stupid mistake of mine. And then the right one that I opened, guess I could just copy and paste it, but I'll do this. Call, debit, bullish, 120 expiration, 279, 280, 15, same price at 23, luckily. And haven't closed that yet, so no profit and loss on that. And let me pull up Discord. How do you sell a cover call against your leaps for Robinhood? You have to have level 3 options if you don't have it. And you have to have a margin account. So if you don't have those 2 things, you won't be able to do it because it's basically a spread option. So get those 2 things down and you should be able to trade it. And you would just sell a cover call just like you would if you own the 100 shares. But, all right, let me see what other trades. We cut losses on the BLK. Where the hell is that one? There we go. Closed it today. And I closed them at 0.64 a piece. And I think that's all the trades that I logged today. Besides that one, actually, I got filled at 9 cents, so saved myself an extra $15. 0.09. So 210 loss instead of 225. What else? Any other trades that I opened? Nope. Netflix, we haven't closed yet. So that's all the trades that I made today. I meant to show this earlier, but we are getting rid of the spreadsheet soon enough, and it will be replaced, if I can find the damn thing, with this nice app right here that I'm working on. Basically spent my life savings developing this app or hiring somebody to develop this app for me. So hopefully you'll like it, and we'll see. But basically it's going to tell you all the stats that you need, just like my spreadsheet does, but it's in a much sexier fashion than my spreadsheet. And it's also going to have artificial intelligence baked into it to where it's going to act kind of as a coach. That's the idea behind it. In the beginning, obviously, artificial intelligence gets better with time, so it might not be as useful in the beginning, but hopefully as more people use it, it'll be better and better as a coach. Currently working on the front page on the Doric. So this is going to be available to y'all very soon. I'll just have y'all give your email just so I can gauge the interest in it. Let me see. But basically it's going to be AI trading journal, track your trades, improve your strategies with the help of artificial intelligence. This is a dashboard, and I'll create the sign up soon so y'all can give me your email, and then y'all will be the first to know whenever it is available. So yeah, that is the end of the trading day for me. It's 10:29, and I will catch y'all tomorrow at 9:30. See you, everybody.